Welcome to the deep dive. Here we take complex information, pull out the key pieces, and basically give you a shortcut to being genuinely well informed. Today, we're diving headfirst into, well, the pretty fascinating world of Bitcoin's market dynamics, specifically looking at where things stand in June 2025. We've got a whole stack of sources in front of us, institutional analysis on supply and demand, some really granular on-chain data, and broader macro reports, too. Our goal here really is to cut through the noise for you, help you understand the complex, sometimes contradictory forces shaping Bitcoin right now, and maybe reveal some surprising facts, those critical insights you need to really get a handle on this landscape.
Yeah, it's fascinating, isn't it? How many signals the market is sending that seem to pull in opposite directions. You've got this like incredible internal strength within the network itself, but then pushing against that are these really significant external headwinds. We're going to try and break down how those forces are clashing, what it means for Bitcoin right now, and maybe what it signals for the future too.
Okay, let's unpack that. The Bitcoin halving back in April 2024, that was a huge moment, right? It fundamentally reset the economics for miners. What was the immediate, the direct impact of that event?
Well, the halving, it's baked into the code. It cuts the new Bitcoin supply rate. So the block subsidy, which is the main reward miners get, dropped from 6.25 Bitcoin per block down to 3.125. That immediately sliced their main revenue stream right in half. So global issuance went from about 900 new Bitcoin a day to just 450. A predictable shock, sure, but a severe one for their bottom line.
And we saw that hit reflected directly in a key metric, didn't we?
Oh, absolutely. The hash price, basically what miners earn per unit of computing power per day, it just collapsed. It went from over, 12 cents in April 2024 down to about 4.9 cents by April 2025. That's more than a 50% drop. And that really made energy cost the absolute make or break factor. You see profitable miners now really clustering where they can get power below 4 cents per kilowatt hour.
Right. But here's where it gets really interesting for me. Despite that intense pressure, miners aren't just, throwing in the towel. They're adapting pretty creatively, actually. Where are they going and how are their business models changing?
Yeah, it's a major adaptation. In response to that margin compression, profits getting squeezed, there's been a big geographic shift. We're seeing a lot of expansion into places with really favorable energy policies. The Middle East, especially Oman and the UAE, they become prime spots. They're offering government-backed energy subsidies, rates as low as like 3.5 to 4.5 cents per kilowatt hour. Parts of Latin America, some Asian economies too, they're also key battlegrounds for this cheap power.
And it's not just about chasing cheaper electricity, is it? The business model itself is evolving.
No, it's much deeper than that. It's a strategic evolution, really. They're
Yeah.
really sophisticated operations. They're now leveraging their core assets, like these huge power agreements they have, advanced cooling systems. They're using that infrastructure to serve the booming demand for high-performance computing, HPC, and AI work. This pivot gives them a stable, often fiat-based, contractual revenue stream. It de-risks them from Bitcoin's price swings. It basically turns them from just Bitcoin producers into versatile digital infrastructure providers. Pretty smart.
It is smart, but it's still kind of amazing that while individual miners are clearly struggling, the overall health and security of the Bitcoin network itself seems stronger than ever. That feels counterintuitive. How's that possible?
It does, yeah. We
Yeah.
raise an important question, but it's true. The network's total hash rate, all that computing power securing the blockchain, it just keeps climbing, setting new all-time highs. After a dip in 2024, down to maybe 519 exahashes per second, it surged past 900 EHs in May 2025. And now in June, it's consistently running between, say, 700 and 830 EHs. So naturally, mining difficulty has also shot up to record levels, hit nearly 127 trillion in late May.
Wow. So what does that tell us about network security then, this constant increase in hash rate?
It signifies this ongoing arms race, you could call it. It's led by the big publicly traded mining companies, the ones with easy access to capital. They're aggressively upgrading to the absolute latest, most energy-efficient ASICs, those specialized mining chips. We're talking cutting-edge 3-nanometer, even 2-nanometer tech. And this dynamic, it forces consolidation. It pushes out the smaller guys, the less efficient ones. It's basically completed the shift of mining from, a hobbyist thing to a fully institutionalized, industrialized sector. Now, while that does centralize the mining landscape somewhat, paradoxically, it makes the network itself much more robust and secure. A 51% attack becomes just prohibitively expensive.
Okay, let's shift focus slightly to miner behavior itself as a market signal. We're seeing a really split picture when you look at their treasuries, the Bitcoin they hold, and what they're sending to exchanges.
Yeah, if we connect this to the bigger market picture, looking at the on-chain data, you see this significant split. The largest public miners, they're showing real conviction. They're holding, even accumulating Bitcoin. Take Marathon Digital, MRA. Their treasury grew to nearly 50,000 BTC by the end of May 2025. They sold 0 Bitcoin that month. Riot Platforms, RIOT, holding almost 19,000 BTC. Strong hands there.
That sounds incredibly bullish from those major players. But then the aggregate data tells a different story, right? This is one of those contradictions you mentioned earlier.
Exactly. While the public guys look strong, the broader on-chain metrics, they paint a picture of, well, distress for many others. Crypto quant data showed this unprecedented surge of Bitcoin moving from miner wallets to exchanges in late May 2025. We're talking over $1 billion worth on several days. Historically, that kind of flow is a pretty strong indicator that sell pressure is coming.
So if the big, efficient public miners are holding, what does this clash of data tell us about who's actually doing the selling?
It points to a really critical conclusion. This isn't some uniform, sector-wide panic sell-off. The intense selling pressure, it's not coming from those efficient, well-capitalized leaders. It's almost certainly originating from the forced liquidation, the capitulation, basically, the miners giving up of the less efficient, maybe private or over-leveraged operations, the ones who just can't make it work profitably anymore. There was research from the Miner Mag suggesting the median cost to mine a Bitcoin was expected to top $70,000 in Q2 2025. That's a tough hurdle. So this environment is triggering a kind of Darwinian cleansing. Healthy for the network long-term, maybe, but definitely painful for those getting flushed out. You can almost feel the heat from those rigs struggling.
Right. Okay, switching gears now. The launch of the U.S. spot Bitcoin ETFs back in January 2024, that's become such a dominant structural force in the market. How exactly are these vehicles shaping demand?
Oh, they've become this just relentless engine of demand. Absolutely relentless. In mid-June 2025, for instance, they had an 8-day streak of net positive inflows. It culminated in a single day, June 18th, where they pulled in $388 million net. And since mid-April 25, these ETFs collectively have absorbed a net total of $11.2 billion in capital.
That's huge. How does that stack up against the new supply of Bitcoin being mined each day?
Well, that's the key, isn't it? On many, many trading days, the demand just from these ETFs alone has dwarfed the new daily supply, which is only about 450 BTC now, remember. We're talking demand outstripping supply by 5 times, sometimes even 10 times, just from the ETFs. It creates this massive structural supply-demand gap. BlackRock's IB is leading the charge naturally. Over $50 billion in cumulative net inflows. They hold over 3.25% of all circulating Bitcoin now, commanding like 55% market share among the U.S. spot ETFs. Fidelity's FBTC is a strong second, around $11.5 billion.
And what about Grayscale's GBTC? That one's been bleeding assets, right? Huge outflows. What's the story there?
Yeah, GBTC has seen significant outflows. About $23.2 billion is left since it converted to an ETF. Another $16 million just on June 18th. It seems to be driven by mainly 2 things. First, fees. GBTC has a high expense ratio, 1.5%, compared to just 0.25% for IBIT and FBTC. So you get fee-based rotation, investors moving to cheaper options. Second, there's a tax friction. Early GBTC investors sitting on huge gains might be reluctant to sell and trigger a big tax bill. Grayscale's new lower fee mini trust, ticker BTC, that's basically a defensive move to try and hang on to those investors. Okay, so this massive structural ETF demand connects to another really fascinating point, the vanishing supply of Bitcoin on exchanges. What are we seeing there? This is one of the most powerful bullish signals right now, I think. The amount of Bitcoin held on centralized exchanges, which is basically the supply readily available for trading, it's just plummeted to historic lows. Just over 1 million BTC in June 2025. That's down 14% just since the start of the year. It means over 500,000 Bitcoin have been pulled off exchanges in less than a year. That signals a really strong intention from investors to hold long-term, in cold storage offline wallets. And it's not just exchanges. OTC desk balances, where institutions trade, are also at all-time lows.
So coins are flying off exchanges, and a huge chunk of them are just sitting tight. What does Glassnode's illiquid supply metric show us?
Exactly. Glassnode's illiquid supply tracks coins that haven't moved in a long time, coins with a low spending history. That metric hit a new all-time high in May 2025, 14 million BTC. That is a staggering number. It tells you the vast majority of the roughly 19.7 million circulating Bitcoin is held by entities with strong conviction. Strong hands, as they say. You can see it visually, too, in the HODL wave charts. Those bands representing older coins held a year or more, they just keep getting wider. More supply settling into long-term hands, not actively trading.
And are those long-term holders, the LTHs, are they still holding strong? Or are they starting to cash out at these higher prices?
Well, another piece of evidence supporting their conviction comes from something called Coin Days Destroyed Momentum, or CDD. Basically, it measures how much old Bitcoin is being spent, and that metric turned negative in June 2025. It indicates that long-term holders have significantly dialed back their spending and profit-taking. Now, some midterm holders, maybe 6-12 months, they've taken some profit, sure. But the really old coins, largely dormant, it implies this collective belief that the cycle top isn't in yet, that higher prices are still expected.
So this dual shock, you mentioned the halving, cutting new supply, plus ETFs pulling existing supply off the market. What does that really mean for the supply side overall?
Taken together, all these dynamics, the low exchange balances, record illiquid supply, low LTH spending, it points to a supply shock that's historically unprecedented. It's structurally driven. Unlike past cycles where the shock was mostly just the halving reducing new flow, this 2024-2025 cycle has this double whammy. Less new Bitcoin plus this massive ETF-fueled vacuum sucking up the existing liquid coins. It's made the available supply tighter than we've ever seen before.
Interesting. Now, this raises a question. We've focused a lot on institutional demand for Bitcoin, but is any of that capital starting to rotate into other digital assets, like Ethereum, for example?
We are, yeah. We're seeing clear signs of that now.
Yeah.
Capital rotation, notably from Bitcoin to Ether. On June 2nd, 2025, BlackRock did a pretty significant portfolio rebalance. They sold about 5,300 BTC worth maybe $560 million, and at the same time bought over 27,000 ETH worth around $70 million. That, plus you see strong inflows into the new U.S. spot Ether ETFs. It signals these sophisticated relative value calls being made by big asset managers. It's likely driven by things like Ethereum staking yield potential, its role in DeFi, decentralized finance. It really looks like institutions are building these core satellite-type portfolios. Bitcoin and Ether is the core, maybe 60% of their crypto allocation. Then they supplement with altcoins, say 30%, and maybe 10% in yield-bearing stablecoins.
Right. Okay, so while Bitcoin's internal picture looks pretty strong, fundamentally bullish even, its price in 2025 has definitely been held back by, a challenging external macro environment. How is Bitcoin interacting with other major assets right now for you, the listener, trying to place it in the broader financial world?
Yeah, connecting it to that bigger picture, its correlations have been shifting. It's shown a really significant decoupling from gold, actually. Gold surged to new highs, over $3,500 an ounce. JP Morgan analysts even called it a kind of zero-sum contest for capital, looking for that inflation hedge, that store of value against fiat currency debasement, with flows literally moving out of gold ETFs and into Bitcoin ETFs. But conversely, its correlation with U.S. tech stocks, particularly the NASDAQ, has gotten stronger. Institutions seem to be grouping these high volatility assets together in their risk buckets. So it suggests the market, right now at least, is treating Bitcoin more like a tech play than pure digital gold.
And what's been the single biggest macro headwind for Bitcoin?
Oh, undoubtedly. It's been the U.S. Federal Reserve's monetary policy, no question. Their June 2025 meeting ended with what the market called a hawkish pause. They held rates steady. And even though headline CPI inflation has cooled off, down to around 2.4% year over year, the Fed's staying cautious. Their dot plot, where they signal future rate expectations, showed a real reluctance to start cutting rates until late 2025. 7 out of the 18 committee members actually saw no rate cuts at all this year. Fed Chair Powell even pointed to things like the reintroduction of U.S. trade tariffs as a potential new inflation risk they're watching.
So what does this higher for longer interest rate reality mean for an asset like Bitcoin?
Well, primarily, it increases the opportunity cost of holding something like Bitcoin that doesn't offer a yield. Investors can get decent risk-free returns from government bonds right now, but more broadly, it tightens overall financial conditions, it reduces global liquidity, and that tends to dampen appetite for speculation, for risk assets in general. You also have other global headwinds like the ongoing tensions, say, between Iran and Israel introducing volatility, and broader risks like escalating U.S.-China trade tariffs could strengthen the dollar, which is typically a headwind for Bitcoin too.
Okay, so given all these forces pulling in different directions, the strong internals, the macro caution, what does Bitcoin's technical price structure actually look like right now? Where is it sitting?
The price has basically entered this prolonged period of consolidation since it peaked back around $112,000. As of mid-June 2025, it's trading in this quite well-defined, gradually tightening range. You've got major support down between $100,000 and $104,000. That includes the big psychological $100 K level, and also the previous cycle's all-time high from December 2024, which was around $103,600. Then major resistance is up between $109,000 and that recent all-time high of $112,000.
And what are the technical indicators telling us about where it might go next from within this range?
Yeah, the indicators really confirm this indecision, this coiling action. The price is kind of dancing around its 50-day moving average, which is near $106,000. Longer-term moving averages are providing underlying support. The 100-day is around $96,500, the 200-day around $92,000. Both the RSI, Relative Strength Index, and the MACD, they're giving pretty neutral readings, not overbought, not oversold. But maybe the most critical signal right now is the Bollinger Bands. They are visibly compressing or squeezing. For listeners, what that typically signals, and it's usually quite reliable, is that a period of low volatility is ending. And it's likely going to be followed by a significant price expansion. The direction isn't guaranteed, but a big move is often brewing.
So this consolidation, this tightening range, what does that suggest about volume and the potential energy building up for a breakout?
Well, looking at on-chain volume profiles, you see a really high concentration of transactions happening right within this current $100 K to $110 range. That builds a strong foundation, a lot of agreement on value here. A sustained move above $112,000, that would push the price into price discovery, basically. Uncharted territory with less defined resistance. And there's another subtle but potentially powerful bullish signal, the on-balance volume, or OBV, indicator. It's actually been trending upwards, even while the price has been moving sideways. This kind of bullish divergence often suggests that underlying buying pressure is quietly accumulating, even if the price isn't showing it yet.
Okay, let's dive into the derivatives market. That's become such a huge factor, a massive force. What's the leverage situation looking like there?
Yeah, the scale is just striking. The sheer amount of leverage, aggregate open interest, that's the total value of all outstanding futures and options contracts, stands at an enormous $96 billion. That's nearly 10 times higher than what we saw during the 2020-2021 one-cycle peak. Glassnode has a metric, the realized cap leverage ratio, and it's in the top 11% of all trading days since 2018. So it confirms we're at historically high levels of speculative leverage. What this means is the market is just primed for volatility. You've got these large clusters of liquidation levels built up just below that $100 K support and just above the $112 K resistance. If price hits those levels hard, it could trigger cascades, forced buying or selling.
But here's the paradox again, right? This incredibly high leverage isn't matched by equally high optimism or euphoria in the market, is it? That seems odd.
It is odd. It's a real paradox. Despite all that leverage, the traditional indicators we look at for speculative froth, they seem surprisingly muted. The Bitcoin futures premium, for example, the gap between futures and spot price, has actually fallen to a 3-month low. It's trading below that typical neutral range of 5% to 15%. Same with funding rates on perpetual swaps. Those have been pretty normal, even dipped negative briefly sometimes. So what this suggests is the leverage isn't being driven by, euphoric retail traders piling in long. It points more towards sophisticated, often market-neutral strategies used by institutions, like that cash and carry trade or basis trade we talked about earlier.
Right, the cash and carry. So buying spot, selling futures, locking in that small difference. That explains the high open interest without necessarily high bullish conviction.
Exactly. You have these large hedged institutional positions driving up the open interest and leverage figures, but it's not the same kind of directional speculative bet that retail might make. It potentially makes the market structure a bit more robust than if it were just pure retail leverage, but it's still flammable. A big price move can still trigger those liquidations regardless of the strategy behind the position. And CME data for June kind of confirms this picture. You see a cautious but very active institutional presence. Put-to-call ratios on options linked to IBIT are around 0.91, and general Bitcoin options show maybe a slight premium for puts, suggesting some hedging or downside protection is in place.
So when we pull back and look at the whole sentiment landscape in June 2025, what's the overriding theme?
The big theme, the defining feature right now, is probably one of the most profound divergences we've ever seen in Bitcoin's history. It's this stark chasm, this huge gap between the behavior of sophisticated large-scale investors and the behavior, or maybe lack of behavior, from the retail crowd.
And what are the social signals telling us about that retail sentiment specifically? Are they piling in or are they hesitant?
Yeah, looking at social media analysis, it reveals a market that's deeply divided. and actually leaning slightly pessimistic right now. For every bullish comment you see about Bitcoin's price, there are about 1.03 bearish comments. That negative sentiment ratio is actually at its lowest point since April 2025. Now, from a contrarian viewpoint, you could say this lack of retail optimism is constructive. Market bottoms are often formed when retail is fearful or just disinterested. It suggests there isn't widespread FOMO yet.
And the crypto fear and greed index, that popular gauge, that seems to back this up. No extreme greed.
Yes, exactly. The fear and greed index is firmly in neutral territory. It's been hovering between, say, 48 and 54 in mid-June. That's a significant cool down from the greed levels, like 70 we saw just a month before. So it confirms we're not seeing that extreme greed that historically signals an overheated market, maybe close to a top.
But the really powerful signal, maybe the clearest evidence of this split, is directly on the blockchain itself, right? This whale versus retail divergence in holdings.
Yes, this is where the on-chain data provides just incontrovertible evidence of this huge behavioral split. It's quite striking. Over just a 10-day period in mid-June, look at these numbers. The number of wallets holding 10 or more Bitcoin are proxy for whales. Institutions, that number increased by 231. In that same 10-day period, the number of wallets holding between 0.001 and 10 Bitcoin are retail proxy that declined by a massive 37,465. It's a classic pattern. You see it time and again. Wealth transferring from perceived weak hands to strong hands. And we're seeing new whales. These are large wallets that are less than 6 months old. They've more than doubled their holdings just since March 2025. They now hold about 1.1 million BTC. To put that in perspective, that's equivalent to absorbing 10 months worth of all new Bitcoin mined.
Wow. So what does this retail retreat, this lack of participation, actually mean for where the price might go next? Is it a bad sign or potentially fuel for the future?
Well, it's kind of both, isn't it? The absence of significant retail buying is partly why we're seeing this price consolidation now. There's no strong FOMO-driven momentum pushing things higher, but it's also a major source of potential fuel for a future rally. If or when the price does break out decisively upwards, the return of those retail investors, likely driven by that fear of missing out again, that's what could provide the real rocket fuel for the next major leg up. They'd be chasing an already incredibly tight supply. It's like a huge pool of potential demand just waiting on the sidelines.
Okay, so let's try and bring all this together. We've got the minor struggles and adaptations, the relentless ETF demand, this huge supply getting locked up, the whale accumulation versus retail caution of the macro headwinds. Considering all these powerful opposing forces, what are the likely scenarios for Bitcoin's path through the second half of 2025?
Yeah, it really feels like the market is balanced on a nice edge right now, a critical inflection point. And the direction it takes from here seems like it will be determined by this core tension. Bitcoin's incredibly bullish internal fundamentals versus this cautious, somewhat restrictive external macro environment.
Let's start with the bearish case then. What could trigger a move down, and where might the price head if support breaks?
Okay, the primary trigger for a bearish move would almost certainly be a decisive technical breakdown. Below that critical support zone, we identified roughly $100,000 to $103,600. What could cause that? Well, maybe an unexpectedly hawkish Fed statement, pushing rate cuts even further out. Or perhaps a serious escalation in geopolitical conflict that really spooks global markets. A drop below $100 K would very likely trigger a cascade of liquidations in that heavily leveraged derivatives market, that long squeeze we mentioned, where forced selling pushes prices down faster. In that scenario, the first major support level to watch would probably be the $90,000 to $92,000 area. That lines up pretty well with the 200-day moving average. A more severe breakdown, if that level doesn't hold, could potentially open the door to a retest of support down around $85,000.
Okay, that's the downside risk. Now, what about the bullish scenario? How does that supply shock potentially ignite and send prices upwards?
The catalyst for the bullish case would be the opposite. A sustained technical breakout above that major resistance zone at $109,000 to $112,000. What could spark that? It could be positive macro news. Maybe inflation cools faster than expected, prompting a more dovish signal from the Fed. Or honestly, it could just be that the supply side gets so incredibly tight that even the current ambient demand is enough to overwhelm sellers. A clean break above the $112,000 all-time high would put Bitcoin into price discovery mode. It would also likely trigger a short squeeze, forcing those betting against Bitcoin to buy back, adding fuel to the rally. And this new wave of demand would just slam into that historically thin liquid supply we talked about. That combination usually leads to pretty rapid price appreciation.
And if we do see that bullish breakout, what kind of price targets are analysts talking about? Where could it potentially go?
Looking at technical projections and the consensus from various analysts, the initial target following a breakout, maybe for Q3 2025, seems to cluster around the $130,000 to $135,000 range. If the rally extends further, maybe into Q4 towards the end of the year, forecasts from institutional players like Fundstrat, Standard Chartered, and also looking at historical power law models, they tend to suggest a range somewhere between $150,000 and $200,000. Now, some people speculate even higher, of course, but those figures seem like a reasonable expectation for a significant rally if we get that clean breakout from the current consolidation range first. That breakout is key.
So wrapping this up, what does all this complexity mean for you, the listener, trying to navigate this market? We've really unpacked a lot. The surprising resilience of the big miners, the just relentless ETF demand vacuuming up supply, that fascinating split between whales accumulating and retail holding back, and all of it playing out against this backdrop of bullish internal forces clashing with these cautious macro headwinds. It's quite a setup.
It really is. And it brings us, I think, to the crucial question looking ahead. You have this market that's so clearly divided, strong institutional buying on one side, retail indecision on the other, an incredibly tight supply. How might a significant shift in global liquidity may be triggered by a real pivot in central bank policy, like the Fed finally starting to cut rates decisively? How might that finally tip the scales? Could that be the catalyst that unleashes the full power of the supply squeeze we've been describing? That feels like the ultimate pivot point everyone's watching for.
Indeed. Definitely something to think about, something to watch closely as these powerful opposing forces continue to grind against each other. Thanks for joining us for this deep dive.